Hi there, I'm here with Jack Bains, partner and head of the Restructuring and Insolvency group at Macfarlanes, and alongside Jack I'm with Paul Keddie, also a partner at Macfarlanes. We're here today to discuss the launch of the 2022 edition of the International Comparative Legal Guide to Restructuring and Insolvency. Just before we do that, Jack, and I don't want to cast our minds back to COVID too much, but I'm interested to discuss and hear your point of view around the emergence of one thing in particular. It seems as though there's been a lot of liquidity within the market, and that's kept a lot of businesses out of insolvency throughout the pandemic.
Yeah.
I'm keen to hear from you whether you think the emergence of new lenders has played its impact in this.
In short, probably not, or at least not yet. In our experience, we saw a lot of incumbent lenders, banks, credit funds continuing to provide support in the early stages of COVID and the lockdowns that arose as a consequence of it. We were hearing stories of bankers phoning up their borrowers to ask why they hadn't drawn down on their revolving credit facilities yet, and wanting to make sure that businesses had enough liquidity to get through what was going on back then. We also saw sponsors being very supportive, where it made sense for them to be able to do so, and combined with that private capital, there's obviously, as lots of us know, a lot of money coming into the system from the government intervention, a lot of the government guaranteed loan schemes that became available. So in a way, actually, there were probably fewer opportunities for new investment by investors in distressed opportunities during that phase, but for reasons we'll come on to, I do expect that to change.
Great, fantastic. Paul, given the challenges that have arose due to the accumulation of liabilities over the past couple of years, how have you seen the insolvency professionals change in their response? And have you also seen any new tools come into the market?
Yeah, in terms of new tools, like most jurisdictions, the UK introduced kind of procedures that were designed, temporary procedures that were designed to deal with the pandemic and the effects of the pandemic in the summer of 2020. So they were things like preventing creditors from taking certain type of enforcement action, preventing landlords from taking enforcement action. They were just designed as kind of temporary relief for businesses to get them through the pandemic. There were also some more permanent changes to UK insolvency law. So a couple of new procedures were introduced which were designed to kind of be a feature of UK law during the pandemic and afterwards. The two most notable of those were the restructuring plan and a standalone moratorium procedure, neither of which had featured in UK law before. So the restructuring plan it's kind of similar to a scheme of arrangement, which is an existing UK process, but it's a bit different. It's also similar in a number of ways to Chapter 11 in the US. It allows a company to effectively do a kind of comprehensive restructuring of all of its liabilities and its entire balance sheet through a single process. It's been used maybe around 10 times or so since 2020. The reason being is that the process requires 2 court hearings. There's a lot of cost involved. So far it's been used mainly by kind of larger businesses. There's lots of talk going on about how it could be used in the mid-market and be done more cost effectively. But I think that might become more commonly used going forward when people get to grips with how to do it on a more streamlined basis and then use it for more kind of mid-market style businesses. The moratorium just is a procedure which allows a company to effectively get a stay against creditor action. So it's similar to a number of jurisdictions have a kind of similar process, but it's it's designed to be very streamlined. There's not, in most cases, not much court involvement. And it just allows a company with a platform to do a restructuring or a financing without creditors enforcing against it and kind of distracting the directors and so on. Again, it's not being used as much as the government first anticipated. Initially, the government thought there'd be 1,000 a year or so of these. So far, there's been less than 20. We were involved in the only one that's gone to court so far, which is a restaurant group called Corbin & King. Again, there's a number of reasons for that. One reason is that the kind of temporary reliefs that I mentioned earlier meant that companies didn't really need to use the procedure because they already had an effective moratorium from a number of types of creditor enforcement action. But similarly, there are some kind of aspects of the procedure which mean that a number of companies aren't able to use it. But again, now that we've had one that's gone through court and people are kind of getting to grips with the procedure and how it can be used, we expect to see it being used a lot more frequently going ahead, particularly if, as people expect, there's going to be a lot more businesses that need to be restructured over the coming years.
Great. Thanks, Paul. Now, you've mentioned those new tools, and I'll throw this to both of you, actually. In terms of asking you guys to get your crystal balls out, which is always a little bit difficult, I'm keen to hear what you guys think about what's going to happen in the next 12 months, particularly for businesses and their balance sheets. What should people be watching out for?
I'll let you go first, John.
Okay, thank you. I mean, there's worryingly, there's a huge amount of turmoil, I think, coming down the line here. Many people are aware of, and you're seeing a lot of the statistics, like the 9% inflation rate in the UK, but that inflation, which is driven by energy prices rising, is driven by supply chain issues, some of which are global, some of which are unique to the UK, and of course the impact of the war in Ukraine. All of these things are combining to give rise to those inflationary pressures. And when you combine that with central bank responses around increasing interest rates to try to react to the inflation, all of those things actually combine to have a really significant impact on the consumer wallet. And where you've got economies and sectors of economies that have always been quite reliant on consumer spending, as you see that potentially having to be drawn back by individuals and households, that will inevitably have an impact on businesses and cause significant distress, and that's a really big concern down the line.
Yeah, I mean, you got to think back to 2019 before the pandemic, and there was already around that time a lot of talk about whether there was another recession coming along. I think there was a lot of talk about where you had a lot of companies that, since the financial crisis, have been kept going by cheap money, the kind of zombie company phenomenon. And during COVID, those companies, they were able to access liquidity. They relied on government support. They managed to get through, but they're now coming out of the pandemic and having a look at the liabilities they've accumulated. A lot of them will have accumulated money to landlord obligations to landlords. The tax man. They might borrow more from existing lenders or via the government support schemes, and there's still a number of businesses that are probably over indebted. And what we've seen is businesses coming out of the pandemic more on the kind of smaller end and then just going straight into liquidation. They can't be restructured because they've taken on so many liabilities. Directors just think we're going to basically liquidate the company and have and start up again. And I think that will kind of translate into more kind of trading insolvencies and liquidations in the mid-market as well. It's not really happened yet. We've seen a couple of trading administrations where an administrator has been appointed to a business. They've had to trade it just because the liabilities are such they can't find anyone to buy it, pretty much. I think there's going to be more of that going forward, just because that by the time that a company gets someone an insolvency practitioner in to run it, there's no hope of it being sold. They just need to kind of do the best they can and wind it down. I think that will be a feature going forward as well.
Fascinating stuff ahead, and I suppose that brings me quite nicely on to this year's edition of the International Comparative Legal Guide. Now, we have Jack here as contributing editor, so I would probably like to hand over to you to explain what's new this year in terms of coverage and topics that we may have just discussed now, but also some new stuff as well.
Thank you, James. Pleasingly, this year we've been able to increase the range of jurisdictions that we cover. So we've got new chapters which look at the regimes in Brazil and Luxembourg, for example. We've also got a couple of chapters which just look at the activities of some of those organisations out there, organisations like Insol International, which help people like us to collaborate with colleagues in other jurisdictions, and finding those opportunities to share experience, learnings from things that don't necessarily go so well, so we can all think about how we might look to update the way in which we do things in our respective jurisdictions is always a good thing, because ultimately what we're all interested in is trying to preserve value, preserve jobs, and get the best recovery we can when a business falls into financial difficulty. We're also really pleased this year to have some really interesting thought leadership pieces. So our colleagues at Wachtell Lipton in New York have written a chapter around updates on what's happening in Chapter 11 procedures in the US, how they're using what's called the Texas two-step to deal with mass tort claims that are affecting the viability of companies. Our colleagues at Kirkland in Munich have written about what's happening, and it's a bit of a tongue twister, but how cross-class cram-down is being affected across various jurisdictions in Europe as a consequence of, or since, the EU directive on preventive restructuring frameworks. And of course, without wishing to blow our own trumpet too hard, Macfarlanes, we've written a piece just looking at the position of shareholders on restructuring, because it's all too easy, I think, to say a business is in financial difficulty, therefore you must put creditors first, and shareholders are almost by the by. Actually, there are all sorts of ways in which they can either add value or be obstructive, and there's a lot more to think about. So we try to put something together to just look at that. Great,
thanks very much, Jack. Paul, interested just to hear how you guys use it on the private practice side and your thoughts on the ICLG series.
Yeah, I mean, there's probably two key ways that we use the publication. Firstly, we'll send it out to our contacts, our legal, who might be legal counsel, kind of credit funds, PE, and a number of our clients, and it gives them a kind of easy to use guide, so they can refer to the laws in a particular jurisdiction before they go off and talk to local counsel in that jurisdiction. So it's really helpful for them. And it's also helpful for us. If we often need to go out and speak to local counsel when we're doing a restructuring, and it gives us an ability to kind of look at the guide, get an overview of what the law is in that jurisdiction, so we can then go and talk to them on a more informed basis than if we just came to it completely cold. So it'd be a very useful tool for us and our clients.
Great. Glad to hear that, and thank you to you both for coming along today, discussing the industry and the publication itself. We look forward to the continued success, not only this year but also into the future. And thanks for joining us at home as well.
Thank you, James. Thanks so much.